Well, hot on the heels of Disney announcing the launch of its $7 streaming service set to debut in November, investors will get a closer look at the competition as Netflix will report their earnings after the bell. What can we expect? Well, here to weigh in, our very own Deirdre Bolton, and David Nelson is back with us. All right, the estimates here, what are we looking for?
Okay, so estimates at 57 per share as far as the earnings go, and revenue would be $4.5 billion. So if that 57 cents comes in, that's about a drop of around 10.5% if you do same quarter a year ago. And as far as the revenue, if they do hit that $4.5 billion number, that would be about 21.5% higher compared to 7. So just remember the last quarter. I think this is more important. You know, Netflix whiffed a bit on the revenue number. They did exceed Wall Street's expectations for the earnings and the subscriber growth. Here's the two things that anyone cares about. Net adds for subscriber growth, just how many new people are signing up. Growth in Asia, that's a big thing. And then just an update on the cash burn, right? Because last year, the company went through $3 billion. It's likely to be the same or slightly worse this year.
What's the estimate for the net subscriber addition?
So net subscriber, there is a difference between domestic and international.
Sure.
So Netflix has already guided for
they've
this.
They've almost maxed out here in America.
Yeah, and they've been very clear in their defense. So 1.6 million domestic, 7.3 million international. I spoke with Rich Greenberg, BTIG, great analyst, great media analyst, and he said, listen, that international number, that's what everybody's looking for. They want to see growth in Asia. The U.S. market is mature, which we know what that means.
In the meantime, Netflix has been one of the hottest stocks of the year. Got dinged a little bit on that Disney news, David, but investors always come back to this. Even when they miss periodically over the last 4 or 5 years, this has been one of those names that rebounds quickly. They got the first mover advantage. And here's the question, I guess. Yeah, Disney has this amazing, vault of movies that we've already seen. But what about original content? And there's their premium to be demanded by the stock and the company for having premium original content, rather.
Well, I don't care how you get it. Either you can grow it, you can buy it, you can rent it, but whatever you do, you got to get it, and you got to deliver on that. But the only thing that grows as fast as their revenue is their debt load. They continue to have to come out with debt. I think we understand now why Disney bought the 21st Century Fox assets. I think that's a huge win. $6.99, that's the new value proposition. I'm not sure I'm the best person to ask about this name. I missed the last 200 points in the stock. But I look at the valuation of this, and I say to myself, you know what? There's nothing proprietary about this technology. Disney is not going to be the last media outfit to come out and invade this space. There's going to be many more.
Well, how many companies, though, could afford to spend billions, $15 billion a year on content, though?
Maybe not $15 billion.
That built a pretty good
CBS, all these other companies. The CBS offering is very, very good. And you're going to see that expand. Everybody with content is going to come out with some kind of a streaming service, and you're going to dilute the space.
Yeah, you have AT&T coming out, Warner with the partnership there. You have NBC Universal. We have Apple. But Apple is spending $1 billion, and Netflix spends at least $13 billion. You know, we'll get an update on that.
By increasing a debt load, you can only do that for so long.
But listen, I don't have a dog in this race, if you like, but Netflix does have 140 to 200 million subscribers worldwide, and they're sort of the 800-pound gorilla in the room. The thing that Disney does have going for it is, if you're a Marvel fan, talk to any of them. They're so dedicated. Same with Lucasfilm, Star Wars, or if you have little kids, all those Disney properties. So I actually don't think this is an either-or thing. I think they're quite different.
Let's be honest, though. I think the Disney announcement, two things. I think Iger stand on was about 50% of the move. The other half was the fact that they're willing to lose a lot of money on this. Because we were talking subscriptions initially $12.99, right? And that's $7. So, it's a race. It's a race where both companies probably will lose money in an effort to get eyeballs.
Disney whatever says it's going to take 5 years to break even.
Right.
Don't you think it puts certainly a lid on what people are willing to pay? Because if at $7 there, that eliminates the possibility that Netflix can continue to raise.
Why do you think Netflix got an upgrade this morning by a Tier 1 firm looking for $400 a share? Listen, maybe they have the Amazon effect. Maybe this is one of those companies that has such dominance around the world, perhaps one competitor, that at the very least, you know what, if Disney and Netflix split the world, then what's wrong with that?
I think they do have a first-mover advantage, and I think they're the ones to beat right now. They're in the lead. That's why they got that upgrade.
Betamax had a first-mover advantage.
Now, that was easy to duplicate.
No, but look at just Bird Box, right, which I did not see, but had 80 million views in the first 30 days alone. So when Netflix does create original content,
I missed the last 200 points, so don't listen to me.
And we are listening. I'm just saying, I'm just having fun, you know? It's like, I'm here to argue.
It's a great discussion to have. We'll know in about an hour. This is a very influential stock, folks. Thank you both very much for helping us break it down, Deirdre and David.